Inflation and interest rates remained key concerns in the second quarter, but a notable shift occurred as the European Central Bank became the first to lower its base rate by 0.25%. Other central banks, including the Bank of England, are likely to follow later this year with cuts of their own. China's economy rebounded in the last 3 months following rate cuts and government stimulus measures. Increased exports driven by aggressive price cuts boosted economic activity and investor confidence, and the stock market rebounded strongly. Japan, previously favoured by investors for its rapid growth, experienced a slight economic contraction recently, which contributed to the slight decline in its stock market. On the whole, economic growth, falling interest rates and reasonable valuations are supportive of both equity and bond markets. Bond markets were volatile amid uncertainty, yet easing inflation led to declining yields in the US and UK towards the end of the quarter, with potential rate cuts anticipated soon. Looking ahead, bonds remain an attractive asset class due to their sensitivity to interest rates and a positive inflation outlook. With expectations for continued moderation in inflation, there is cause for optimism. However, any adverse news on inflation and monetary policy leads to a softening in bond prices, and so we're maintaining only a moderate overweight to longer-dated bonds and focusing on quality issuers to try and ensure we avoid any defaults. The equity markets broadly continued to rise in Q2, with the US markets leading the way, whilst there was a notable rebound in both Asian and the emerging markets. The US market's growth was driven largely by the tech sector, with Apple and Microsoft performing strongly and Nvidia briefly becoming the world's largest company. Prospects of rate cuts moved equity markets, leading to rallies in Europe and the UK as investors anticipated looser monetary policy and more favourable economic conditions. We have continued to maintain a balanced stance in our portfolios, ensuring exposure to high-quality investments in both the bonds and equities markets. Our fund managers are now holding some quite long-dated bonds, which, when interest rates are cut, should be a positive contributor to portfolio returns. Where appropriate, we also continue to hold positions in alternative strategies to diversify risk and to try and help deliver smoother returns during those times when stock and bond markets are volatile. Global economic growth is expected to remain robust, whilst both inflation and interest rates will probably remain higher than we saw before the pandemic. But volatility is expected to persist in the foreseeable future, with events such as elections, ongoing conflicts, and economic data continuing to heavily influence short-term market movements. Equities should continue to deliver good returns, whilst in bonds a higher for longer interest rate environment may mean the majority of returns will come from healthier coupons rather than capital gains.